Well, thanks so much for tuning into today's Talking Point. I'm your host, Neeraj Shah. Our guest today is Abhay Agarwal of Piper Serica. He's just come out with a very interesting investor letter. And of course, uh, Piper Serica under Abhay have also managed to have a successful closing of their maiden venture fund in the private markets, if I'm not wrong. So Abhay, congratulations on that.
Thank you so much. And as again, Neeraj, wonderful to be back on your show.
Thank you so much. So Abhay, let's start off with the India stack, the India opportunity. We were talking to Temasek as well, who straddle both the private and the public markets, and they say that after a while valuations might be an issue in select pockets, but both the private markets and the public markets together are giving very equal and very large opportunities. What is your sense now that you straddle both ends of the market?
Yeah, Neeraj, I think that is exactly the reason that we decided to straddle both the markets, because while there are over-researched large caps and Nifty 50 constituents are part of that, that do not allow for much valuation, asymmetry, because those stocks are over-researched and everybody's focused on them. I think in the listed space also, once you go below that top 200 stock, let's say, and, look at stock specific, company specific situations, you realize there is valuation asymmetry, which gives a great opportunity for long-term investors. Just because those stocks are not researched properly, and no one is really looking at that space right now because those companies are smaller. And that carries on into the private space. And in the private space, we see, despite all the talk about the froth, I think there are pockets, there are founders who are very sensibly building their businesses and looking at raising money at the right time, at an appropriate valuation, which still leaves enough money on the table for investors. So I think Tamasek's perspective is absolutely right. I mean, they have been incredible investors in India for more than 20, 25 years. So they have a very good perspective. And in a very small way, we are replicating that by saying that, look, we are equity investors. We take equity risks. And the equity risks can't be limited only to the large caps. And if you want to make long-term money, 5-year, 10-year perspective in India, then I think the zone that you want to be in are the mid caps, small caps in the listed space, and in early stage private companies.
Abhay, by characteristic, and I was reading your investor letter, there seems to be, and I mean, so in terms of the exits that you've done, because you've returned a handsome 23% for the quarter, which is spectacular. So congratulations on that.
Thank
But
you.
when one looks at the kind of exits that you've done, or the kind of companies that you've added, on the additions, there seems to be a bent towards value. On the exit, it's not necessarily getting out of only expensive stocks, but also where growth is getting slowing or showing signs of slowdown. So tell us how you're thinking about the markets currently.
I think that's a great read again, Neeraj, of the investor letter, and I'm really glad you got that. So as investors, we're always looking to be very stingy about valuations that we pay, and while we don't want to be seen as bargain hunters or bottom pickers, we want to come in at a time when companies are getting into the growth zone, but are available at valuation, if I may use that term. And I think that allows for returns to come in from both multiple expansion as well as earnings growth. And I think that is what gives multi-bagger returns. So that is where our focus is on. And I think like thematically, we are playing the whole textile apparel export space, where we have added some companies. Because those companies were trading at bottom of the cycle valuations, available at multiples of ranging from 7 times P multiple to 14 times P multiple, getting into an earning growth zone. Similar for small banks, microfinance companies, NBFCs, which are again trading at a substantial discount to their larger peers, but are on a faster growth curve. So we like to pick opportunities like that. And I think, again, what happens is sometimes these stocks re-rate very quickly. So if we come in at 14 times and suddenly 2 years later, these stocks are trading at 45, 50 times, And then the story has played out and it's become a popular stock. Participation has gone up. So we don't want to time the market. We would like to stay invested for as long as we can, and we typically do. We have stocks in the portfolio that we have held on for 8 to 10 years. But then sometimes, if opportunity presents in these small mid caps to exit at a handsome gain, we take that also. And I think that's what you saw us mention in the investor letter.
But the nature of the additions as well, or the nature of your holdings, Abhay, seems to suggest that you don't seem to be too bothered about some skepticism that may be there in some quarters of the market about how the broader end of the spectrum, despite the valuation still being lower than large caps relatively, looks a bit overheated. There's a lot of talk about how the promises being made by some small cap companies are just too good to be true, and therefore there is froth there. You don't seem to be believing that there is necessarily froth at the broader end of the spectrum.
Yeah, Neeraj, after spending 30 years in the market, I would like to believe that there is always a froth in some part of the market. And mid caps, small caps, absolutely, they get frothy earlier because they go from the cycle of very low liquidity to very high liquidity. Suddenly for a long period of time, there is no participation and these stocks are trading low and nobody wants to look at them. And suddenly they become popular and then everybody wants to jump into them. And a small amount of money comes in and these stocks re-rate very fast. So I think for mid cap, small cap space, it is easy to get frothy because of lower liquidity, and I think that is where we like to use our research framework to very clearly define what is the right value and is there enough juice left for us as investors. And wherever we see juice vanishing, we exit. We watch it, we track it, but for the time being, we exit and redeploy elsewhere. So we have a coverage of about 60, 70 stocks that we look at regularly. We don't trade, but I think in mid-cap, small-cap space, as you rightly said, something is getting frothy, something is getting bottoming out. So there is an opportunity to reorient portfolio periodically.
Got it. So let's talk about some of these, and then I'll talk about some. Actually, let me talk about the newsmakers first, then I'll come to your portfolios, if you will, Abhay. Newsmakers. Sure. Information technology had a bit of a upswing on Friday. This week as well will be inundated with numbers, starting with LTTS today, Infi at some point of time later in the week, and some others. LTI came out with numbers. You exited the stock as well, but the numbers seem to be a bit conservative relative to what was estimated. How do you look at information technology? Do you look at it at all, or is it too confusing currently because the trends from various companies and the comments from various companies are very, very disparate?
We do look at it, Neeraj. It's a very, very large space, and we have looked at it for a very long period of time. We currently do not have any IT stock in our portfolio. The reason for that is that when we look at the demand environment, it's still very weak. There are two problems with large cap IT companies that they are facing. One is related to the demand environment, where customers are saying that, look, I want a higher ROI. So I'll give you a $200 million project, but I want a very high ROI on this. So you need to deliver more in terms of efficiency and productivity gains. Now, the typical large IT companies like TCS, Infosys, LTI, Mindtree, and not only Indian companies, but global companies, Accenture, IBM, Capgemini, have traditionally worked on a time and material model, which is staff the projects with cheap resources and make a hefty 20% EBIT margin. Now that is under threat existentially, from the business perspective, because customers are saying, I don't care how many people you have, I want higher productivity, I want higher ROI. And these companies will take time to transition to use of technology to replace human resources, and at the same time, if you look at what's happening in the technology world with the use of AI across the board, and we see that in the US startups a lot of the simple coding work that these companies would get paid for is vanishing. And that's the reason that you're seeing capacity additions, like TCS added some 500, 600 people in the whole quarter, because that whole model is creaking now of time. And so it will take time for these companies to reorient their business. So for the time being, while they do that, I think that the growth will be high single digit at best for next couple of years, which does not justify the current valuations. And purely for that reason, we are happy to sit out the IT space for the time being.
There are two behemoths, if you will, having their own technical aspects to themselves in addition to the fundamental growth, which is HDFC Bank, or rather now HDFC Bank, and Reliance having this whole spin-off listing, so on and so forth, and some of parts coming into play. Um, what's your sense about um, the investability in such large companies? Of course, they are both having their individual triggers or individual issues within themselves. What's your sense here?
These are fantastic companies. You look at HDFC, remarkable, iconic company with, great franchise, unbeatable franchise, and the kind of growth they keep showing quarter on quarter, it's just remarkable. And with the resources they have, I'm very sure that the integration will go well for HDFC. On Reliance itself, again, phenomenal story, from India. And these are the two largest market cap companies now in the country. So I think these are, for a fund manager, for an investor, despite the size, one needs to have them in the portfolio at some sensible allocation levels and just leave them there, because they will go through their various ups and downs. But if you look at a large, long point-to-point interval, they would generate returns. So I think these are going to be very steady performers that will probably generate 1.5 times to 2x IRR of India's GDP growth, just by the kind of the businesses that they are in. So I would not worry too much about their size and the fact that they've become too big. I think there's substantial room for them to still grow from where they are.
Okay. The other is the spate of AGMs within the Adani Group, and viewers, standard disclaimer, of course. Adani Group owns 49% stake in Quintillion Business Media, which owns the platform on which you're watching this Talking Point show. But Abhay, the AGM and Gautam Adani quite up there to talk about the whole Hindenburg issue, straight up taking the bull by the horns, and then kind of talking a lot about how India itself is poised to grow so well, and therefore within that, anybody who wants to take a large opportunity bet will probably stand a good chance to succeed. What are your thoughts, if any?
Yeah, as again, fund managers, I personally believe that Mr. Adani is absolutely correct, in his thinking and in his saying, and what he's saying is at a much higher level than we would look at. But I mean, his vision is way beyond just looking at the stock prices of his companies, and he's looking at a much bigger, clearer picture of India's growth, and I support that. And I think some of the attacks that have happened on the group over the last 6 months are expected, because when you grow like that, when you are successful, there are people who may not be happy with that. But I don't think that the kind of strategy that the group is following, and in fact maybe it's a blessing in disguise what happened, because it gave them a reason to deleverage, to restructure the balance sheets, to come back stronger. I personally believe that a lot of restructuring that they have done in terms of just deleveraging the founder's balance sheet and the company's balance sheet is going to lead to material success for the entire group. I think the assets are very high quality. The management is quite good. So overall, I would say that I won't be surprised if the whole group stocks come back and outperform the market over the next couple of years.
Okay, and that leads me to my next question. I mean, not just for the group, but per se, this whole infra story in India, it's kind of making a bit of a comeback, Abhay. I mean, GQG saying how they value is one thing, but just the fact that the quantum of projects being unveiled in the country, the number of private players, private global funds wanting to take a part in that, are you excited about making money through the listed route into the India infra opportunity, or are there other ways to play it?
No, I think, Neeraj, I think that the listed space is the only way to play it. And I'll tell you why. Because this execution of these projects requires significant amount of own balance sheet strength. So you need to have very large amount of capital to see through these projects, because these projects go through their ups and downs. And you can't get into a situation where at the time the project is struggling for some reason, you are dependent on external capital. So I think uh, your own capital is very critical for success of these large projects, and that only large groups and large companies can afford. Um, and we saw this play out in a different way 10, 15 years ago when a lot of small companies that got into infrastructure development, and most of them have died, gone bankrupt, are into NCLT for the simple reason that they did not have the balance sheet strength to see through these projects. And a lot of power projects, road projects got stuck. NHEI, had to struggle through completing some of those projects. But this time around, the good thing is that the infra development that is taking place by people who have the balance sheet strength, the management capability, and the technical capability to see through these projects. So this time, I think that the infrastructure development over the next 4 or 5 years will be much better than what we saw the last time around. And I think the only way for investors to play that is to stay invested in very high quality infra developers rather than trying to play it through smaller players who may have a very volatile time executing these projects.
Got it. A couple of questions on the portfolio and then a couple of macro questions, Abhay, before we wrap up this conversation. I hope you have that much time,
Sure.
about 5 odd minutes. Now, you've added textiles quite significantly, seemingly. I don't have the exact numbers, but I'm just guessing that it's a nice thought through process. Is this a case of a sector which is maybe at the bottom or curving up higher because they've not had the best last couple of quarters, and therefore the valuations are in your favor for what could be ahead? What's the logic?
So we have about a 15% allocation, 16% allocation
Wow.
to 3 textile apparel exporters in the portfolio. And these are not investment recommendations or,
Of course.
full disclosure, but, so companies like Gokul Das, SP Apparel, Himmat Sinka, they may seem like brave bets, but, again, when we looked at it, we realized that this whole apparel export sector has got beaten down over the last 3-4 years. Very low participation from the investors since we started adding these names, because there was a slowdown in the US demand. More importantly, cotton prices spiked very sharply. Almost doubled in 6 months last year, because of which the margins fell. But now cotton prices have come off. They are at their lowest in the last couple of years, I would say. Again, excess supply, and the US demand environment is picking up. The fears of US recession is reducing, and these guys are very, very good manufacturers. So I think that gives us a lot of comfort when we visit their facilities. When we talk to the management, we realize that at the core, these are great manufacturing stories. They have great plants, they have invested in the best quality machines, processes are sound, people are good. So all that they need is some support from the demand environment, some support from cost inflation, and which is exactly what is happening now. The only missing piece now is the FTA, but that will be a big upside. Even if it doesn't happen, I don't think the story is going to stop. If that happens, then suddenly these companies will become even more competitive. So we like situations where there is uncertainty, and we believe that bottom of the cycle has been crossed, and now there's a sharp up curve ahead for next 3-4 years of value creation. So that is where this story kind of fit in for us.
Okay, got it. Abhay, last couple of things. India, I mean, slightly macro now. We've spoken enough about the micro. When we are talking to, let's say, for example, Temasek or a couple of others as well, and we asked them about what is it that their global counterparts within that team spoke about with the most admiration about what's happening in India, the India stack, JAM, UPI came up right up there. Now we've seen news bits of India-France payment linkage, India-UAE payment linkage. This morning on Bloomberg, there was conversation about India-Indonesia payment linkage as well. How important could this be? I mean, we know that it's great, it's important, but does it translate into significant economic benefits? Have you thought through this at all? Maybe, I'm sorry, I'm throwing this out of the blue at you.
No, it's a very good question, and I'm really glad you are that you're bringing it up for your viewers to understand the absolute amazing things that are happening on the payment side, and not only in India payments. A lot of we are absolutely proud of what UPI has done to our country in terms of money velocity. Taking payments, of as less as 5 rupees, are being done digitally. So what happened in UPI domestically is now going to happen through UPI internationally, and that is very important because the the frictional cost right now of international remittances in and out is very high. Banks charge as much as 4-5% on currency conversion charges, and I'm sure, Neeraj, you have paid that. When you get your credit card bills from international travels, when you come back and you say, there are significant markups. So that is an extremely inefficient part, and that is slowing down trade because our sellers don't get money on time. Our buyers have to struggle to pay money, to transfer money. So I think this initiative is going to take away a lot of that. Just like credit card merchant charges fell dramatically, what Visa and MasterCard was charging to Indian card holders and digital payers. I think the same thing is going to happen to our SME, MSME, even large exporters and importers once this kicks in, because the velocity of trade will increase significantly and the cost will come down dramatically. So I think it's a remarkable initiative, and the impact of that will be felt only over the next couple of years.
Okay. Lots of moving parts to this, and looking forward to that. Abhay, one final word. Janet Yellen, no less, has said that US will skirt the recession. There might be a slowdown, not necessarily a recession. Does that mean that the Fed will be even more emboldened to stick to higher rates and hike higher? And therefore, is that a negative? Or do you reckon that the US demand looking okay, weak but okay, not necessarily a recession, is a positive from a equity markets perspective?
Yeah, I think US has probably already gone through a mild recession. It didn't probably reflect in the numbers, but US is such a vibrant economy, Neeraj, that it auto-corrects itself much faster than others because it's such an open economy. So it goes through its pains very quickly, and I think that pain has already been gone through. And what the Fed is now looking at is saying that, look, are there other triggers to bring down inflation? Anyway, inflation is ceasing to be a problem for Fed. So I don't think going into an election year, Fed is under any pressure to further increase rates. In fact, last time they saw when they increased rates, their own banks started going under. So that is the last thing that Fed would want to do. I think there are other methods available for the Fed to rein in liquidity rather than just increasing rates. And I think US is probably getting into a bit of a Goldilocks scenario now for next 6 months to 1 year, which is exactly where they wanted to be in the election year. So I personally don't think that equity markets at this point of time are over worried about the Fed increasing rates, maybe at 25 bips towards the end of the year. But I don't think there is any worry that the inflation is such, either in US or in India for RBI, that there is a reason for a rate increase.
Abhay, so good talking to you. Thank you so much for being so candid on all the things that I asked you. Viewers, standard disclaimer, please don't treat any of the things that Abhay spoke about as recommendations. They're merely illustrative examples to explain his point. Abhay, thanks for taking the time out.
No, thank you, Neeraj. Always my pleasure to be on your show. Thank you so much.
Always our pleasure having you. Viewers, thanks so much for tuning in to this edition of The Talking Point. Thank you, Abhay. Much appreciated. Thank you. Lovely show. Thank you.